Hello, everyone. This is Michael Cochran with Untitled Capital. October brought a wave of major headlines, from corporate earnings to Federal Reserve policy and global trade developments, all influencing the market outlook as we head into year-end. We began with the government shutdown. While the shutdown is difficult for affected workers, history shows markets typically look past such events. Spending is delayed, not lost. The 2018-2019 shutdown lasted 35 days, yet the S&P 500 gained over 30% that year. Talk of government job cuts has also surfaced, but they represent a tiny share of the total workforce, less than 2%. So while shutdowns create real challenges for individuals, their broader economic and market impact is likely to remain limited. Corporate America, on the other hand, keeps delivering. More than 70% of the S&P 500 companies have now reported third quarter earnings, and an impressive 83% have beaten expectations. That puts the index on track for a fourth straight quarter of double-digit profit growth. One of the biggest stories this season is the surge in capital spending from big tech. The top 7 tech giants are expected to invest over $500 billion next year to expand AI infrastructure, fueling what's become a full-blown AI arms race. Investors have mostly cheered this wave of spending, though the lukewarm reaction to Meta's results shows that the market is starting to demand a clear payoff from all that investment. The Federal Reserve added some uncertainty around the path of interest rates. Chair Jerome Powell made it clear that a December rate cut is far from a foregone conclusion. As expected, the Fed trimmed rates by a quarter point at its October meeting, but the tone was less dovish than markets hoped, pushing Treasury yields higher. Powell also highlighted a no hire, no fire trend in the labor market, with companies largely holding headcounts steady among economic uncertainty. From our perspective, the balance suggests the Fed will likely continue easing into 2026, even as inflation risks linger. The U.S. and China have hit pause on trade tensions. At last week's APEC summit in South Korea, President Trump and President Xi agreed to a one-year trade truce. The deal includes lower U.S. tariffs, renewed Chinese soybean purchases, and a halt to new rare earth export restrictions. With the effective tariff burden now around 12%, lower than many expected, this easing of trade friction is giving corporate earnings a welcome boost. Markets have responded positively to recent developments, marking the 6th straight monthly gain for the S&P 500 and the 7th for the Nasdaq. While past performance never guarantees future results, history shows that November through April is often the strongest stretch of the year for stocks. Yes, some gains may have been pulled forward and market leadership remains concentrated, but overall, momentum is still strong. With economic conditions steady and earnings growth holding up, the backdrop for investors remains encouraging as we move into year-end. In closing, stronger than expected earnings, easing trade tensions, and favorable seasonal backdrop are being balanced by a supportive, though less predictable, monetary policy environment. As we approach year-end, it's a great time to review portfolios, discuss any updates from this year, explore planning opportunities in the final months, and make sure your strategy is well positioned for the year ahead. Please feel free to reach out to our team here at Untitled Capital to discuss any of these updates.